If you've got over 50% of your portfolio in UK funds, you're actually making a really big bet that the UK stock market is going to perform well. Listening to the media commentators and your friends who give you hot share tips, that is a recipe for disaster. £170,000 of missed investment gains. If you study the history of the markets, like what we're doing now, then you will understand why that probably is a good strategy. In today's video, I'm going to show you 5 investing mistakes to avoid, including why some investors lose money, and more importantly, how you can avoid this, why you haven't left it too late to start investing, and talk a bit about how companies are valued and how that can help us. Although our podcast just passed 750,000 downloads and our email list has over 41,000 of you on it, we're really new to YouTube, so thank you so much to everyone that left a comment on our previous investing video called 5 Reasons You Should Invest in 2023. Those comments really help us to make content you find useful, hopefully like this. So let's get straight into today's charts from JP Morgan's Guide to the Markets. This first chart shows why the average investor can lose money. So what it shows is the 20-year annualized return by asset class. That is a lot of jargon for a chart title, and I'm going to take you through it. So annual return is pretty straightforward. It's just how much your investment has grown or shrunk, which does happen, in 1 year. Okay, the annualized return is the geometric average of the annual returns of each year over the investment period. So essentially, it's the average return taken into account compounding. The reason I'm laboring this point is some people start looking at a chart like this and start investing and think the S&P 500 in blue is going to return 7.5% every year. No, it's not. But the annualized return of the S&P 500 from 2001 to 2020 was 7.5%, which means on average that was the return. Some years you might be up 30%, some years you might be down 60%, and we're going to look at that in a bit. So hopefully that explains the annualized return. But really what you need to take from this chart is that the average investor, shown by the green bar, has significantly underperformed both the S&P 500, which is a big basket of shares that's based in America, but more importantly, the 60-40 refers to a portfolio, so a series of investments that's made up of 60% shares and 40% bonds. And we talked about that in the previous video. So the average investor has massively underperformed. And what does that mean in real terms? Well, if you invested £100,000 in 2001, at the end of 2020, that average investor's underperformance leads to nearly £170,000 of missed investment gains. Underperforming like the average investor is not good. So you're thinking, how can I avoid being the average investor? And that is exactly what today's video is about. The main reasons why average investors underperform could include no investment aims and plan. If you don't have an investing plan of what you're going to buy and when, then you are able to changing your mind and listening to the media commentators and your friends who give you hot share tips. And that is a recipe for disaster. And kind of related to this, you need a solid list of objectives and goals and a well thought out plan. And more importantly, when the going gets tough, you need to stick to your plan. Another reason might be that you're paying too much fees or even taxes. Short-termism could be another reason why average investors lose money. In our previous video, which I'll link in the comments, we showed why really 5 years is the minimum term that you should think about investing. Another reason could be something called home bias. And home bias means that you're more likely to buy stocks and shares in your own market. So for example, 1 in 2 UK investors have over 50% of their portfolio in UK funds, and yet the UK makes up just 3.7% of what we call the global stock market index. And I'm going to talk more about this towards the end of the video, but this home bias can be really problematic if your home market underperforms. And really what we're saying is, if you subscribe to Jack Bogle's theory of don't buy the needle, just buy the haystack, which we talked about in the previous video, if you've got over 50% of your portfolio in UK funds, you're actually making a really big bet that the UK stock market is going to perform well. And we're going to show you why that might be a problem. But really, all of those reasons are small fry compared to the main reason that average investors underperform, and in our example lost out on over £170,000 worth of gain. And that is behavior. And you're sat there thinking, hang on, investing is all about numbers and stock markets, wearing red braces and reading the Financial Times. But it's not. Investor behavior, that's you and my investing behavior, especially when stock markets are going down, can have a massive effect on your investing success or otherwise, and can be a major reason why you lose money. And let me show you another chart which help explain this. So this chart shows in blue, we have the flow of money into the market, that's going above the line in blue, or out of the market, below the line. And in black, we have the overall performance of the market. And what this chart shows is that historically, investors have shown a tendency to sell their investments near the bottom of the market when they're at their cheapest. And that's indicated by the net outflows from this US equity fund, the areas that have got a red box in them. And you're thinking, why is selling at the bottom of the market so bad? Well, what this chart shows is that a lot of investors are tempted to buy high when things are going well and the prices are high, and sell low. And just think about that for a minute. You're buying high and you're selling low. This is a great way to lose money investing. Let's just say, for example, your favorite shoe shop has got a sale on. You'd be much more likely to buy a pair of shoes that you've got your eye on for months if, for example, in the sale, they were 20% less, because you're getting the same pair of shoes, the same product, for 20% less. In fact, sometimes when there's a sale on, there might even be a big queue outside the shop, such is the desire to buy in the sale. But as that chart shows, when the stock market has a sale and things are going 20% discount, instead of queuing up to buy at a discount price, the investors sell perfectly good shares or shoes that they bought a few months earlier for a massively reduced price. And that is buying high and selling low. And that is why behavior is a massive determinant of how your investments do. And you can control your behavior by having a good plan, which I already talked about. You're thinking, why is buying high and selling low so bad? And the reason is because it's always darkest before the dawn. No, this isn't about Florence and the Machine. It's about what happens to the market after a big downturn. So that brings us to the next chart, which shows what happens in the performance of American stocks in the 12 months following a 25% drawdown. So what happens if the market falls 25%? What happens in the following 12 months? And we can see for the vast majority of these 25% drawdowns, the following year is actually a booming year for the stock market. So it crashes hard, but it bounces back. And you can understand that if you sell out right at the bottom and get really scared and sit on cash for a year, you actually miss out on this massive bounce back, which is shown in this graph. So let's just take the most recent big drawdown in the stock market, and that was in 2020, the COVID crash. So following the COVID crash, the following 12 months, the stock market performed over 60% gains. So if you panicked at the bottom and sold low at the COVID crash and then didn't get back into the market for a year, you lost out on that 60% gain. And this is what we call timing the market. Timing the market is nearly impossible, and it's another reason why the average investor underperforms. And you're sat there thinking, I invested a load of my hard-earned money in 2019. In 2020, the value declines by more than 25%, and you're just saying, don't worry about it. Well, essentially, if you study the history of the markets, like what we're doing now, then you will understand why that probably is a good strategy. But before we talk about ways to avoid this bad behavior investing, we just need to make clear that everything I'm about to say assumes that you're investing in a broadly diversified fund covering most or all of the whole global market. If you're buying cryptocurrency or individual shares, basically none of what I say is going to be relevant to you, and I hope that you've done your own research if you are pursuing that strategy. But let's assume you're investing for a long period of time. First way to avoid panicking is what I call, if in doubt, zoom out. So let's have a look at this video. Don't look at the 1 month returns. Don't look at the 6 month returns. Don't even look at the 1 year returns. You might be okay looking at the 5 year returns, and you'll understand why if you've watched our previous video, 5 reasons to invest in 2023. And if you look at the maximum returns, you will be reassured that over time, the market goes up and to the right. But within that period, there is huge volatility. The next reason that I try to use when riding out one of these volatile periods is to think in terms of units. So when you buy a share of a fund, you are buying a unit of that fund. And if the price of that unit drops 50%, you still own the same amount of units, okay? Yeah, those units are now 50% cheaper, and you could make the argument that if they're 50% cheaper, it's like when there's a sale in the shoe shop, you might consider buying more. I personally don't do that because I don't believe in market timing, but try to think about it like that. Another really effective way that's easy to say but hard to do is just don't look. Don't track your investments. And this is really, really easy for me to say. When I first started investing, I was checking my investments about once every 5 minutes. And if you do that, you're not zooming out, you're zooming in. And during the COVID downturn, it was especially easy for me to not check my investments because as a doctor, understandably, I was absolutely flat out working in the pandemic. Checking my investments was the last thing that was on my mind. And by the time I did get around to checking them, the bounce back had already happened and it was like nothing happened. And if I had had a look at it, day to day, I probably would have seen at least a quarter of my investment portfolio lose its value. So simply not checking and just checking it once a year when you do your annual financial review is also a really good strategy, but it's hard to say. Another thing that you've got to appreciate if you're investing, and I kind of alluded to this earlier when I was talking about annualized return, is that volatility is normal. So this next chart with the gray bars and the red dots shows that volatility, prices going up and down a lot, is normal. And when we talk about annualized return, they actually disguise a lot of volatility, which can confuse new investors. But hopefully you won't be confused because you watched this video. So the red dot shows the largest intra-year stock market decline, and in gray, we see the market's return for the full year. Your take home here should be, it's very common to see a significant decline, even intra-year, and yet still get a very healthy positive return on the year. So volatility is normal. If in doubt, zoom out, check your investments once a year, stick to your plan, and do not get engaged in buying high and selling low. Let's move on to something a little bit different here. This next chart shows world equity valuations. So equities, as you know, if you've watched our other video, is just another way to say shares. And in this case, we're talking about the MSCI World, which is a fund, which we talked about in our previous video, of global shares. So it basically buys a small bit of every stock market in the world. And what this shows is the valuation of developed market stocks based on a PE, or price to earnings ratio. And like medicine, there's just a ton of jargon in investing, but once you understand the jargon, it's pretty simple. So let's get into this PE, or price to earnings ratio. What that PE ratio is, it relates to the company's share price, the P, to its earnings per share. So if the PE ratio is high, it could mean that the stock is overvalued, or that investors are expecting high growth in the future. And also, slightly stating the obvious, but if companies have no earnings or losing money, they don't have a PE ratio because there's nothing to put in the denominator. And so what this chart shows is that the stock market correction in 2022 has brought valuations down to levels that are now much closer to the long-term average PE ratio of 16.3. So what does this mean for investors like us? Well, it could mean that stocks are now much more fairly valued, but as you'll realize the longer you start investing, no one really knows. And the best thing to do is just keep pound cost averaging every month into a well-diversified global index tracker if you think that's the right strategy. Not advice. Let's move on to another chart that shows PE ratio, and instead this time shows the UK FTSE All Share, which is a load of shares in the UK. And I talked a bit about home bias in the past. And what we can see here is that the PE ratio for the UK FTSE All Share at the moment is significantly below the average of 14 times. So what does this mean? Well, it could mean that at the moment the UK market is slightly cheap because the PE is under the average of 14 times. But again, no one really knows. I'm not adjusting my plan based on this chart because once you start getting engaged in that, you just start getting engaged in bad investor behavior. The next chart shows you probably haven't left it too late. So in my previous video, I showed compounding at age 25 and age 35. And I got a question from a 50-year-old A&E consultant. And given my recent predicament, I've got a massive soft spot for A&E consultants right now and the incredibly challenging work they've done. But this 50-year-old A&E consultant asked me, have I left it too late to invest? And the answer is probably not. And this chart might show you why. So what this chart shows is that you need to consider investing for what might be a very long period of retirement. And as this chart shows, for a couple who are currently age 65, there's a 90% chance that one of them will live to 80 and a 50% chance that one of them will live to 90. So if you're aged 50, like the A&E consultant, have you left it too late? Probably not. You've probably got another 30 or 40 years ahead of you in investing. So I hope that helps you. Thank you so much for watching this video. Again, I'm going to ask for your feedback because it helps us to make videos that you like. So comment below if you want more investing videos like this, go for a love heart. If you want more tax tips from Ed, then go for a thumbs up emoji. And if you want to know more about how we started a side hustle, then go for the fire emoji. And if you haven't watched 5 Reasons to Invest in 2023 video, I'm going to link it down there or over there. I mean, I don't know because we're so new to YouTube, but I've seen YouTubers do that and it looks cool. So hopefully we're going to do that for you and you can watch that video where we talk about why you need to invest early to maximize compounding. We tell you why cash is probably not a safe haven, why diversification, the only free lunch in investing, and investing for a long period of time reduces your chances of money. Thanks so much for watching and we'll see you on the next video.